Is Dave Rigetti Computing a buy or a sell? Let's get started with the model. This is a mid-cap company, $2 billion market cap. They're trading at $7.16 a share, and they have 279 million shares outstanding. This company is the developer of quantum integrated circuits used for quantum computers. Quantum technology will one day be able to solve complex problems that supercomputers cannot solve or cannot solve fast enough. It was founded in 2013, headquartered in Berkeley, California. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They really don't generate much revenue, so their free cash flow is negative each year. Net income is the profit or loss on the income statement. It's revenue minus expenses. Same thing, not much revenue, so negative net income. Revenue is the sales for the company, and that more than doubled from 6 million to 13 million, but that was in 2022. In 2023, it was 12 million, and the trailing 12 months is still 12 million. They need to get up to the $1 billion range to start making some money for their investors. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows, past year 4, that's 4.7 billion. We discounted those numbers back to today using a weighted average cost of capital. We get a value of the company of $3.5 billion. We divide that by 279 million shares. And we get a calculated stock price of $12.58. They're trading at $7.16, so they're trading at a 43% discount. It's a buy according to the model. I'm assuming they will hit $1 billion of revenue by 2027. If they do that, the stock seems undervalued. On the flip side is they may never become profitable. That's the risk you take when you invest in the stock market. There are 33 companies in the same industry as Rigetti, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They don't spend much on CapEx, 11 million, still more than the median. A good debt to equity ratio, 0.2 for every dollar of equity, 20 cents of debt. Negative free cash flow, as we saw earlier. They rank 11th in market cap at 2 billion. Their price multiples are really poor because they don't generate much revenue, so they're losing money. And the stock is trading pretty close to its 52-week high. Its 52-week low is 69 cents. So even if you got it at $1, you'd be killing it right now. If you put $10,000 into this company when they started trading, at one point, you'd be under $1,000 and you'd be crying. But if you still held on, there was a bull run recently and your $10,000 will be $7,000, a loss of 28%. If you picked it up at this lower quadrant, you'd be up 300-400% right now. To summarize, I have them trading at a 43% discount. This is a pretty risky stock because they're losing money. And who knows if they'll make a name for themselves in the quantum space. Ranking 3 out of 10. Short term, I definitely wouldn't buy it, 2 out of 10. Long term, it's even less likely I would buy it, 1 out of 10. If it comes down a little bit, like it drops 50% in price from this point, it may be a good value because then you could do a swing trade, but I wouldn't hold it longer than a year. Ratio is 1 out of 10. We can't even look at 2 of the 4 ratios. And terrible price to book, terrible price sales. Financial is 1 out of 10 because they're not really generating any revenue. And of course, they have negative free cash flow each year. Here's their income statement. This is the third quarter of 24, third quarter of 23. Revenue is down. It was only 3 million last year. Now it's 2.4 million. Of the 2.4 million, 2.3 million is research, professional services, materials, and sales of quantum computers. Only 72,000 access to quantum computing systems. One of their customers accounts for 32% of their revenue, and then another at 17, another at 14, another at 15, another at 14. That means over 90% of their revenue is from these 5 customers, so it's pretty concentrated. But they're not really bringing in much revenue at this point anyways. Of the 2.4 million of revenue, 1.5 million is in the US, 770,000 in Europe, and 63,000 in Asia. This income statement has percentages. So revenue is down 23%. Cost of revenue is up 41%. Cost of revenue is 1.2 million. So their gross profit is 1.2 million. 2.4 minus 1.2. Gross profit down nearly 50%. Last year was 2.3 million. But they spend a lot more in R&D, 13 million. SG&A 6 million. So their operating expenses are much higher than their gross profit. So they have an operating loss of 17 million, same as last year, 17 million. They spent $733,000 of interest on their debt. They received $1.2 million of interest income. They're probably sitting on a lot of cash. So their net loss is $15 million. Last year, a net loss of $22 million. And they're adding a lot of shares. Last year, they had 134 million shares outstanding, now 188 million. Let's look at their balance sheet. Their current assets, 104 million. Current liabilities, 21 million. So their current ratio is about a 5. They have 92 million of cash or short-term investments. They have a lot of PP&E, 45 million. Their total assets, 157 million. Last year, 160 million. Total liabilities, 34 million. That's down a lot. It was 50 million. Their biggest liability is the current portion of long-term debt. That's debt due within 12 months, 11 million. But they have plenty of cash, 92 million. So they can easily get through the next 2-3 years. And the equity is assets minus liabilities, 122 million. They raised 524 million from selling their business. They took those funds in and lost 402 million from running their business. The difference, the 122 million, is mostly cash, 92 million. Let's look at a statement of cash flows. This is for the trailing 9 months. In the operating section, they lost 42 million of cash from running their day-to-day business. Last year, they lost 38 million. They don't bring in much revenue, so of course they're going to lose cash. In their investing section, they purchased almost 10 million of PP&E. Last year, 7.5 million. There's a lot going on in their financing section. They paid down 9.5 million of notes. They added 13 million of common stock. They added another 39 million of common stock. You want to see them diluting shareholders, not taking on debt, because when you take on debt, you have to pay interest on the debt. And when you have negative cash flow, you can't pay the interest. You have to take on more debt to pay the old debt. Let's look at a company on Simply Wall Street. Its last price, $716, $2 billion market cap, up 64% in the past week, up 569% in the past year. What is going on? It looks like this is a SPAC because it started out at $10. That was in 2021. Then it bottomed out at 42 cents. That was in mid-2023. It was still trading below $1 up through October 2024. By the end of November, it was $3, and now it's over $7. Its highest was $7.38. And the reason for the big rally is one word: Google. Google talked about this company's product, Willow Quantum Computer, and its ability to reduce computing errors while increasing qubits. Google said this is a breakthrough in quantum computing, and investors are excited. Simply Wall Street does not have a value for this company. 4 analysts priced this stock at $3.50, so they say it's really overvalued. Their revenue as of January 2020 was $735,000. This is for the trailing 12 months. Their revenue peaked in September 2023 at close to $15 million. It has come down. The CEO's salary in 2022 was $16,000. Now it's $578,000. Total compensation, $2 million. Tenure as CEO, 2 years. Of course, there's a lot of insider selling, no buying, because a lot of the insiders have been sitting on these shares for a long time, and they saw the stock price go below $1. So when it finally rose above $1, they just wanted to get rid of it and recoup some of their losses. Most people sold at below $2. One person sold at $2.79, 8 million shares. 64% of the companies owned by the general public, 26% by institutions, 9% by VC and private equity firms, and 1% by insiders. The biggest shareholder is Heights Capital, 9%, then Deere Management, 3.8%, BlackRock, Vanguard, and you see some individuals, they probably work at the company, or maybe they're investors. Goldman, another individual. Their employee count was 140 in 2021. It got up to 160. Now it's 134. And the ticker trades on the NASDAQ. So if you want to learn how to build a discounted cash flow model, click on the video in the top right corner. Thanks for watching.